Hello investor, how are you? Today I'm going to cover the ticker name ABBV. Myself Pramod Kumar, I am a CFA charter holder and FRM certified. If you see where it stands, this company, if I list all the US drug manufacturing company, this comes under number 4, right? So when I covered the last video on regarding the Mr. Warren Buffett portfolio, in that portfolio we do see that this stock was there, right? So this is number 4. So what I have done is, this is all the in the healthcare sector under the US US company. These are the company does the drug manufacturing. So the number 1 we know with the 3 Johnson & Johnson, and this company stands here, right? Number 4, right? So right now the PE is 22. If I compare with all, so looks like reasonable from comparative from the other perspective. So let's see whether this company is really good or from the value perspective or not, right? So, and is there any other investors, super investor or fund have invested in this video as well? So that's also the key point here. Next I will try to do the Bristol or Pfizer as well. So please put in the comments if you like this video. Okay, let's go to the key data first. So yeah, so this company has a market cap of $108 billion and the PE is 21.6, round figure to 22. So which is giving the return of annual basis of almost 5%, but given that this is a dividend paying stock as well, so this is not very risky company. The beta is less than 1. So anytime when the beta is less than 1, this is not affected that much with the market movement. So that's what you can say. Okay, this is a major pharmaceutical, and right now it's trading at 110. 1 year target is 110, and the today's high is $102, which is also the almost 52-week high. So pretty much price is going at the high price, and maybe why not, because this is a COVID time and people are buying this kind of stocks. Okay, so from the dividend per share perspective, I just want to highlight here, this is the 2011 to 2019, and when do the intrinsic value of the stock computations, I will use the EV model there or the free cash flow to firm model. In that one I will also use the 10-year of data. So if you can see here, every year the dividend is increasing, right? So look at the growth of the dividend. Its spike is very good, right? So as you know, if you're following me from very long, if I like something, I'll put a flag, 2 flags there, right? So that's good, right? So the company is giving the dividend. Let's see how the company is doing from the share. So pretty much the company is consistent with the number of share outstanding, but seems like with the recent past there is a spike in terms of the share issue, right? From 1.4 something to 1.7 some billion, right? Maybe because of the COVID-19, these companies wants to sustain, but that's still otherwise if you see from 2012 to 2020, 8 years of data looks pretty consistent. From the margin perspective, the margin is quite good. It was way good before, from over 75%. If you can see, if this is a 75%, the margin was pretty good, but now it's lower, but still not bad, is over 65%. From the operating income to and the bottom line, which is the net profit margin perspective, this has been consistent as well, right? So 18 to 28%. So this, from the ratio and margin perspective, this looks good. One good thing I like about it, maybe that's one of the reasons Mr. Buffett also buy this, that look at the free cash flow growth rate. This is amazing, right? I think he might be like those company where as a huge amount of cash pile sits there, right? So look at the cash is 15.5 $1.533 billion cash is sitting there, and it's increasingly insane. When I use the FCFF model, which is in short free cash flow model, at that time I also have show you how much year over year, a 3-year or 10-year growth there to use that. But this is very good in terms of the cash. When I did the Apple, I think Apple stock analysis a few months back, so that also has a very good amount of cash as well. And Mr. Buffett, we know his number one stock in his portfolio is Apple, right? Okay, so this is now we are here. Before we go jump to other, I just find out, so as the Berkshire Hathaway recently add this new stock with the $2.14 billion investment, right? And you might already know that, but not only him, right? There are so many other funds. You can say this is the Kevin O'Leary, right? If you are from Canada, you might know him from Shark Tank. Seems like that's his funds or shares, right? And there are some other companies which keeps buying this as well, right? With the disclosure from September 30th. Okay, so let's go next. Okay, before I go to the model, I'll share some of the liquidity. So seems like from the short term perspective, the company is doing pretty good job in terms of the maintaining covering the short term expenses, because if you can see, this is way above 100%, right? And from the gross profit and other margin looks decent as well. Okay, so let's see the intrinsic value model, the enterprise value model first. So enterprise value, basically how we can compute, just give easy. So we have the share price times the market shares for 10 years of data. Maybe I'll zoom out a little bit, and then we add the debt and reduce the cash, right? So that's how it is. So if I double click here, you can easily see what I'm doing: market cap plus debt and minus cash. So basically, if you have the lot of money and want to buy the whole company, so that's what is enterprise value, right? As the name suggests. So this is my enterprise value growth rate. We can see here, and then this is my operating EBITDA. Basically, this is operating income plus the depreciation before interest and depreciation amortizations. So that's the growth rate I have taken. This is shown, right, for 3, 5 and 10 years. One thing to point out here, this is way good, right? So the debt is less as compared to the EBITDA, right? Is only 4.45. So this means if you go and buy the company, it will only take 4.5 years to pay off its debt, right? So okay, so now once we have this number, feel free to pause and check more details. But what I have taken, I was very conservative in taking the EBITDA growth. As you can see, my 3 years I was even coming as 12.52. Maybe I'll increase a little bit here, right? Okay, and 5 is 30 and then 10, right? So what I just take the 10%, even the recent 3 years I just shred it, and then also I am shredding the growth rate to half in 10 years, and assume sell the company for 10. With if I do the math, I'll get my value of $175, and after 10 years this model giving $233, right? Based on this growth rate. If I take the free cash flow model, in the free cash flow model, basically this is how I have computed, and this is my free cash flow growth rate. Look at the free cash flow growth rate, right? Year over year is very increased. But again, I have, as you can see, I have taken with the recent past is even 25%, almost 25, but I have taken 20, and this time it's just gone crazy to decline to 2%, right? Every year I'm declining the growth by 2. And when I do this math, and my price is $212. So then the next thing is I split the 50% to both model, and then say, okay, give me the price from first model is giving 87 and other is 106. If I do the total, my price coming as $194.07, and after 30 years it's 269. And given that this model is yeah, so that's a bit conservative, right? But still, if I compare with the market with 101, this is a pretty good price. So let's see what's in terms of the IRR, right? Intrinsic estimated value return. So if I go show you this this return, right? So this return, this is the market price. If you go and buy the share at $102, it will give you 21% return, right? That's very good. And then if you go higher or lower, that's you can see the band, right, for the percentage. So that's the projected IRR. So yeah, so that's it from this video, right? I request to subscribe if you're new to the channel, and if you want me to cover any other healthcare stock, feel free to comment it out, and do check some other videos on my channel. Thanks for watching, and bye for now.